everyone, Keshav Kolur here, principal and co-founder of Clive Capital, and I'm joined here by my co-host, fellow principal, fellow co-founder, John Lai.
Hi, everyone.
And today we have a really special episode for you. Usually John hosts these podcasts, but today I will be interviewing John, so I'm here back on our podcast. So without further ado, today we're going to talk about financial planning, specifically financial independence and retiring early, also commonly known as FIRE. So our agenda is understanding the different paths to FIRE, all the different definitions of FIRE and how you can get there, figuring out what your financial independence number is, and then working back, thinking about investment strategy, what the withdrawal strategy looks like, things to consider along the way, and just questions. General disclaimer, this is for educational purposes only. John and I are not financial, legal, tax, any such advisors. This is purely for educational purposes. Always consult your own advisors before making any such decisions. And today's episode is going to be really focused around the strategies that anyone can take advantage of. And in future episodes, we will look at how can we turbocharge the path to financial independence, FI, by focusing more so on private investments in real estate, oil and gas, etc. Those typically come with higher investment minimums and net worth requirements, and so we'll save that for a separate episode, but these strategies in here, most everyone should be able to employ. So, understanding the path to FIRE. Before we dive into that, actually, John, if you want to give a quick update about your journey to FIRE and how you've been preparing it for it all along and your personal experience with it.
Sure. Thank you very much for that, Keshav. Yes. And all along, as a lot of W-2 employees have done in the past, or even if you're self-employed, you've been building up your investment portfolio. And you may not have thought about FIRE, financial independence, or even retiring early, but you really should. And part of what prompted us to record this was because I was recently furloughed at Amazon, and I have been preparing for this point all along. And because of that planning, was able to retire early, which is fantastic, after about almost 25 years of working. So I'm glad I was able to prepare, and I want to prepare each and every one of you to also plan for that, either early retirement or at least that financial independence, so that you too can think about retiring early and also plan for any uneventful or eventful circumstances like this one. So thank you for that.
Yeah, and your career is really well decorated. Amazon, Apple, Yahoo, Mitchell Madison. And so it is a scary reminder that this can happen to any of us, and that we should be prepared for it. But on the bright side, also, it's always good to have backup options. And we know in tech, especially, these are high-powered careers that are well paying. But at the same time, if we can be smart about our finances along the way, then we can work really hard for 5, 10 years, 15 years, set ourselves up by making smart decisions besides just the standard 10% index fund and that's it, and retire early. Or continue working and then at some point, have the option to retire early when we want to. So, John, I'll let you take it away from here and I'll just interject with any questions that I have along the way.
Absolutely. And to the point that you just made, as you are thinking about investing, don't just think about investing and being limited to the broader equity market. Think about how to accelerate that, because that's the whole point behind FIRE is like you want to retire and you want to get to that FU money, right? FU dollar value. With that, let me launch in financial FIRE. What is FIRE? It's financial independence, obviously, FI, and then retiring early, RE, right? And then so it's the idea of getting to a point where you are comfortable with actually retiring and not having to worry about working any longer. There are different flavors of FI, and those different flavors reflect your lifestyle and maybe your income requirements during retirement. And it's not one size fits all. I'm going to go over a couple of different versions of FI. These are popular in the social networks out there. And then they're really based on your tolerance for risk as well as your goals, right? At the end of the day, like when and what you want it to do with the money that you've built up. So these are interesting catch names that define your lifestyle and financial independence. The first is lean fi. It's essentially what it sounds like. It's very lean. It's enough to get you by, but it also sets you up for financial independence. It's bare bones. On the left-hand side, you'll see the time to that financial independence and then the size of the retirement that you need. So you'll see you might obviously think that lean fi is short in terms of time frame, and it is. And then you also need to just build a small retirement portfolio. Really next is Baristify, and this is also interesting. The name came from being financially independent, but also working as with your side gig, whatever it might be. It doesn't necessarily have to be a barista, but the idea being you work part-time while you're enjoying your financial independence. And this is pretty popular. Next is COSFI, and the idea behind this is you've reached that number, that magic number, enough to actually retire financially, so you don't have to work any longer. It's not lavish lifestyle, but it's not lean either, and so that's why it's called COSFI. You can stop contributing to your nest egg. It requires a larger portfolio, but it also requires a little bit more time, but you no longer have to work. And last is FatFi, which is as it sounds, like it's luxurious. If you want that and to continue a higher spend lifestyle, you want to live a FatFi life, a fat financial independence life, that's what you would opt for. Most of our audience, I would imagine, is in the COSFI and FatFi categories, right? You lived not necessarily luxuriously, you probably saved up, but you also traveled, you also are environmentally conscious, you work out, and so you want to live both the coast and fat fi life. What type of financial independence fits you? It depends on the lifestyle, right? It depends on your housing, your travel, your healthcare costs, what you are accustomed to, what you imagine yourself settling into in your financial life, in your financial independence life. That really defines a good deal of which fi or fire lifestyle you decide to choose. Also, is freedom versus continuing to work. If you enjoy working, then you might want to opt for Barista Fi or some other fire type of lifestyle. And then it's your risk tolerance. There's this notion of sequence of return risks and then also inflationary risk. If your risk tolerance is pretty low, you want to build up a pretty sturdy nest egg, right? And so you do, and we'll talk about this in a little bit, you do want to opt for some buffer against any unforeseen events or circumstances. So you want to build that up. And then, of course, you can blend these types of fire or financial independence lifestyles as you need. You can work or you can not work and then eventually decide you actually enjoy working or you want to go back to work and you can do that. So that comes to an all-important FI number. What is your financial independence number? How do you define it? There's a number of ways to define it in the space, in the retirement space. There's a rule of thumb that Bill Bengen came up with in the 1990s. And he was a financial planner and he evaluated the past, I think it was like 80 years of the stock market return. And granted, A, it's just the stock market. And then B, he was looking at 30 years out. He was saying, how can we get to a safe withdrawal rate? And he came up with the 4% rule, which is equivalent to 25 times your annual expenses. So the idea behind that is you look at your monthly and then your annual expenses to the table to the right. What you'll see is you just have to multiply that by 25%, 25x rather, and then you'll get to a number that at 4% withdrawal rate, that this investment portfolio would sustain you for 30 years. Now, for some people who are a little bit more conservative, they want to withdraw at a 3 to 3.5% rate instead of a 4% rate. And so if that's the case, then you would need a larger investment portfolio. If you withdraw at a higher rate, 5%, Bill Bacon recently came out and did a reanalysis and said that you can withdraw at a 4.7% rate. Then you need a smaller investment portfolio, which is fantastic. But if you look at where you are, where your needs are, you can define the investment portfolio that you need. Of course, you can stress test this. Bill Bengen has stress tests through Monte Carlo analyses, and at a really high percentage, 100, almost 100%, he said that you can withdraw at a 4% initially. Now he's saying 4.7%. And of course, you can add a buffer to this and go as large as you want. I wouldn't go that much further than the 4 to 5 rates. You'll see at a 120,000 or 10,000 monthly expense level, you need about $3 million or almost $4 million at the 3% rule.
So real quick here, this, I think one assumption that this makes is probably that your nest egg is in the stock market, right?
Correct. That's right.
Yep.
A
So
mixture
I think,
between when he did analysis, it was 50 equities, 50 bonds.
okay, okay. So then it's probably, you could probably get away with less if you just didn't do bonds, right?
Yes. Yep.
Okay. So that would be interesting exercise, probably for the future webinar. And then this would obviously be completely different if you had it invested in real estate or private credit or oil and gas, anything like that. And so what, John, what percent rule are you using in your calculations?
It's interesting because I actually reached my FI number a lot sooner than I'm retiring now. But we essentially used about a 4% rule. We always followed that rule, but we reached that probably about 2 years, 2 to 5 years ago. And then we just kept accumulating. I didn't follow my own rationale and retired when I got to my FI number. I continued working. And a lot of us will just because you either enjoy your job or you want to play it really safe and be very conservative. I would say like I applied the 4% rule. My portfolio is probably more along the 3% rule portfolio, but I probably conservatively withdraw at a 4%.
Okay. And then what kind of fire lifestyle are you aiming for?
Oh, Fat Fire, definitely. All of us should aim for Fat Fire. Yeah. So the other thing about FI is that you have to factor in, and this requires some planning or working with a financial advisor, is like, what are the events that require a lot of withdrawal of money, right? So if you have kids, they're going to college. If you pay for college, that's a good chunk of your portfolio allocated to that. So definitely do that. There are a number of systems that allow you to do that or work with a financial planner.
You got it. Okay. And then what does your portfolio look like as far as a mix between stocks, bonds, real estate, private credit,
Yeah.
oil and
A- af-
gas?
I would say like now having started and invested with Clive Capital, it's probably 60 equity and 40 private equity at this point.
No bonds.
Almost no bonds. If there are any bonds, it's like in some type of index mix. But
Nice.
yeah, no
Okay.
bonds. Yeah.
Good, good. Okay.
Yeah. Okay, so next, I know this is a pain point for some, especially younger workers, but don't forget Social Security, right? Like Social Security is there now, and it's questionable whether it's going to be there later, but between a certain point in your life, age 62 through onward, you have the option of Social Security. And if you are a US worker, you have the option of Social Security. And what that means is you can withdraw or you can take your Social Security income starting at age 62. That's the early age. Now, your Social Security distributions will be reduced by 30% versus your standard age, which is 100% of your distributions at age 67. The way I look at this is you know yourself, your family lineage, and your health, and how long you will essentially live. If you look at those tables, whether you're going to live to 80, 85, 90, 95, and onward, right? And so depending on that, and by the way, at 70, you get a bonus. It is 124% of your Social Security income distribution that's allotted to you. So you get that bonus at 70 if you can delay taking Social Security until 70. The way I look at it is you should decide based on your family lineage how long you're going to live. Also, in planning for financial independence, if you are financially independent and have that nest egg and don't need to take Social Security, then don't take it and wait until 70 and then take that 124%, that bonus Social Security income, right? So it really depends on when you need Social Security, if you need Social Security. But what I would do is don't plan for it. A lot of those in financial independence don't plan for Social Security because it's just so far out that you won't even think about it. This is just a nice bonus at the end when you don't need it, when you don't think you'll need it.
And it sounds like you didn't account for it either in your
I,
calculations.
I did not account for it. That's right.
Okay.
That's right. The one thing about also financial independence is whether you should account for your primary residence. So some folks, some people do not, others do, with the notion that if you need that extra money, you can sell your home and then live and pay rent, right? And so that's an option. Whether you account for that in your financial independence plan or not is up to you. Conservatively, you should not plan for it. You should set that aside. Or if you still have equity that you have to pay down, if you have a loan, then you should account for that certainly in your plan. Okay, so let's talk about accumulation stage, your investment strategy stage. So this comes from the Money Guys. It's their financial order of operations. It's a little bit different than their FO, financial order of operations. Essentially, what this helps you understand is what should you be doing first, second, third, and onwards. First is you need healthcare coverage. Make sure that those deductibles are covered. Then what is highly valuable is that employer match. So some companies, Exxon, CVS, and others, Amgen, will give you a 10% match on your 401k. That's free money, right? Take that match. I wouldn't invest a whole lot more than their match. We'll talk about why, but take that match because it's free money. If you invest 10%, they'll double it, 10%, you get 20%. That's a free 10% of your money that you're putting in. Next is high interest debt. If you are paying 27% on your credit card, please pay that down first. That's essentially, if you think about it, 27% you would be getting in the market, and that's 27% that you know you will be earning, except for you're paying that as high interest debt on your credit cards. Next is emergency reserves. Make sure you keep that liquid. Some people keep 3 months. If you're nearing toward financial independence, you probably want to keep upwards of 6 months or so. Some people even higher than that, 1 year or so. After that, it's what you want to contribute. So like Roth and HSA are a pretty easy no-brainer, right? Because HSA, both HSA and Roth, you put money in and the money you earn is tax-free. The money you take out is tax-free. Roth is after-tax money. HSA is not. HSA is arguably an even better investment vehicle. Of course, self-directed accounts, when we get to hyperaccumulation, we'll touch upon in the next couple of slides. Self-directed accounts allow you to invest in private equity, which arguably is even better than traditional equity markets, public equity markets, and bonds, certainly. And then, of course, 401k, it's always there, it's available to you. We'll argue that it's maybe not the best vehicle for investments, but we'll talk about that in a little bit. And know that there are contribution limits to these tax advantage accounts based on your income. There's also strategies, you'll see number 7, to reduce your taxes. You want to reduce your taxes, and by reducing your taxes, you can funnel those tax savings back into your financial independence strategy and hopefully hyper accumulate even more, even better. And then lastly, if you have kids, prepaid future expenses, 529s, and then you potentially want to start a company if you have any money left, or just do better in your W-2, earn more so you can participate in 1 through 8 at a higher rate.
And when we say start a company, we don't necessarily mean the next billion-dollar unicorn, but even
Right.
if it's just like a side gig, consulting, or I don't know, like a construction business or something, just something to build additional income beyond your W-2. Or, yeah, like John said, just get really good at your W-2, climb the corporate ladder, but just be conscious of why you're doing it, not necessarily to chase titles and accolades, but just to increase your income so that you can put it back into your investments and get that much closer to fire.
Yep. Absolutely. Let's talk a little bit about those tax advantage accounts. 401k, yeah, you want to maximize the employer match. Like I said, depending on your employer, they might have a 5% match, 4% match. Some employers, I wish I would have known about them, have a 10% match. And so those are great. You also want to max out some of those traditional and Roth accounts. They're after tax. And what those traditionally mean is You don't have to pay taxes either going in or coming out. It's traditional, it's before tax money, but then you're taxed on any money that you withdraw during retirement. And then Roth is after tax, but you're not taxed on any money that accumulates while it's in that account. There are other things like mega backdoor Roth, if you have that available to you, that you should investigate. Do your due diligence, make sure that you look into those. HSA is fantastic. I didn't realize that until too late with HSAs. But if you have a low deductible account, you can invest in an HSA. It's triple tax benefit, meaning pre-tax going in, tax that the income that's being earned is tax free, and then you're not taxed on withdrawals. And you don't
Withdrawals, I looked at this recently. I think you are still taxed unless it's used for health
medical.
care or
That's
medical.
right. That's right. Yep. You're absolutely right. Yep. The tax strategy that those in the financial independence arena use is they just don't use their HSA to pay, but they accumulate their health expenses over time. And after, call it 5, 6, 10 years, they need to have that tax benefit or that monies. They will then take and withdraw from HSA for those medical expenses at that time. And then they have built up, call it 100K, and then they can use it for whatever they need because they've already expended the health expenses. That's one strategy that you can use. Now, Iris, I talked a little bit about those before. We'll talk a little bit about self-directed accounts in a bit, but you can certainly have a self-directed account, invest in 401k, self-directed 401k, or self-directed IRA, and they can invest in most anything, crypto, paintings, any type of private equity, obviously multifamily syndications and private credit and the like. Talk to your CPA about the whether it makes sense to invest in those, whether tax savings, et cetera, out of those self-directed accounts. But those are much more flexible than the traditional 401ks and IRAs, and they're third-party custodians. Okay, let's talk about hyper accumulation. And I touched upon a little bit of all of this along the way, but this is one way I accelerated my path to fire. And we'll cover this in a future episode as well, because I think it's that much more important, traditional fire paths. So let's talk about other sources of income and then income producing options, and then tax savings in a little bit on another slide. So other sources of income, self-directed, I talked about this. These are third-party custodians that permit private equity investments. The power of this is that it permits that third party, that private equity, right? Whereas traditional IRAs, traditional 401ks, if you invest through Fidelity or Vanguard or Schwab, they will most likely have those public ETFs or mutual funds or stocks and bonds, obviously, but they really don't, at least up to this point, allow you to invest in private equity. Now, might change at some point in the future, but for now, they don't allow it. And this option through third-party self-directed accounts allows you to invest in private equity. That opens up a whole world of other options, investment options to you that allow you to then magnify what you've invested. No longer are you just subject to mutual funds or ETFs as low as those funds have management fees. You can open yourself up to other type of private equity that have the ability to magnify your returns or deliver passive income for you. These S blocks, these lines of credit, these are offered by banks. Essentially, what they allow you to do is take your non-retirement portfolio, your taxable accounts, equities and taxable accounts, and then allow you to get a loan, a margin on those assets without having to sell your assets. So it's almost akin to a HELOC on your home, except for it's on your equities. And so these lines of credit allow you to do that. It's great. There are limitations. Typically, it's 50% maximum. And then there are also requirements in case that balance drops. There's risk that they might call the margin, and then you would have to pay off that call. So just make sure you understand the nuances before you enter it. But we're talking about sources of income. If you are just relying on your W-2 and that may not be enough to accelerate yourself to a five path, this is an option that's available to you. And then there's other options for you. There's this option called rate arbitrage. So what we did with our home is a HELOC. And you can take out a HELOC, lower interest rate, and then you can invest it in higher interest rate accruing investments. So those being private credit, whatever it might be, and definitely do your due diligence on this because you do have a loan, HELOC, that then you have to pay off. But if you do that arbitrage, and both the HELOC is more or less a fixed, you might have variable rates, but it's more or less fixed to a rate. And then you have some type of private credit that also has somewhat of a fixed rate, then you can arbitrage the rates, right, between the two. So if you have call it a 7% HELOC, and then you can get a 11 to 13% rate on a private credit investment, then you can arbitrage that difference, which is fantastic. That provides you passive income. Granted, it is taxable interest income unless you put that money into, again, a self-directed account. And then we'll talk about this in a little bit, but there's a notion of a 0% tax on the long-term capital gain. What I didn't know for the longest time is if you buy an equity and then sell it in a taxable account, yeah, the short term, then you would have to pay the ordinary income taxes. But if it's long term, meaning over a year that you hold the investment, then you have up to about $97,600 married filing jointly. Look up the balance for your tax rates, but you have up to 97,600 that you can of long-term capital gains that you can write off. You don't have to pay any taxes on those, which is fantastic. So you can use that again. And this is capital gains. This is not the actual amount that you receive. The actual amount is your cost basis plus your capital gains. So it could be much more than that. You can take that money and then again invest it in these hyper accumulated private equity investments. So income producing, we've if you've followed us, you know about all the different avenues that you can invest in real estate, where you get real estate depreciation, and that offsets the income produced from passive income coming from syndications. So that might be an apartment value add. It could be triple net commercial lease. It could be anything, very many things, not anything, but a lot of different things related to real estate. And with the one big beautiful bill, now we have 100% accelerated depreciation that comes back, right? And which is in the first year, which is fantastic. So definitely look into that because you can shield your passive income. Shielding means that you actually do receive income, but you don't have to pay taxes on that. And then oil and gas. So we've been talking about oil and gas, and the fantastic thing about oil and gas is that 80 to 90% of your investment is deductible in year one. And it's deductible against your W-2 income, your active income, passive, and then capital gains incomes as well. So it's deductible against almost any type of income. And that's why a lot of our audience, the high wage earners in high tech, really love this investment class, asset class, just because it shields your income from taxes. And in private credit, again, if you're looking for that passive income, you can lock in that yield in first position loans and generate that passive income. And then a tax reduction. I talked about self-directed, so I'm not really going to go that much further into self-directed. And the two notions is one, if you recently retired or recently left a job like I did, then you can take your 401k from your job and roll it into a self-directed 401k. If you did not, then you cannot do it. If you can't roll 401ks with your current employer into a self-directed, it can be a previous employer that you might have had lying around that you can roll into a self-directed 401k. And then IRAs, you can do that anytime. You can roll a traditional or Roth IRA into a self-directed IRA anytime. And then think about Roth conversion ladders, especially in the years where you have lower tax rates. So the way that this works is 401k, traditional IRA, those are taxed when you take it out. But in low tax years, if you recently retired or are retired, then you might want to consider rolling those into a Roth IRA where you can accumulate in investments that income without paying any taxes. And then when you withdraw those funds at a later date, then you don't have to pay anything on them. Definitely consider Roth conversion ladders as an option for you. And then, of course, we go back to oil and gas from a tax reduction perspective, and then other types of tax strategies that we have brought to you and we are going to continue bringing to you to minimize your taxable income, like leveraged charitable contributions. There are donor advised funds, charitable remainder trusts, essentially that minimize the taxes that you have to pay out. So look into those to minimize your taxes.
I'll point out also, going back to the self-directed stuff, even if you're not retiring, if you're just switching jobs,
Yep.
one thing is to make sure you do not roll over your current 401k into your next company's 401k. And by keeping them separate, it gives you that opportunity to use your old company, your previous company's 401k, and convert it into a self-directed IRA. Typically, with your current company's 401k, at the time of the recording, you're not allowed to use your current company's 401k to invest it or convert it into a self-directed IRA. So,
That's fantastic. That's exactly right. So withdrawal strategy. We talked about accumulation strategy for investing. Let's talk about decumulation, right? When you withdraw funds.
is that a word?
Uh, Decumulation, I think it is. I've used
Okay.
it. I've,
Interesting.
I've heard it used before. If there's
Okay.
accumulation, there must be decumulation. So let's essentially start with taxable accounts first. Remember, going back to if you have equities and you have long-term capital gains, you can have an AGI of up to 126,700. Now that takes the 96,700 plus the 30, 31 standard deduction, and you can have an AGI up to that amount, which is fantastic. Like you never really think about that. I never really thought about that when I thought about equity investing. I always thought about buy and hold for the longest time. Now you can buy and hold in your financial and retirement strategy. You can buy and sell up to 96,700 long-term capital gains. Fantastic. And frankly, you don't have to retire to do this. You can do this anytime, but in retirement, if you need that day's money, we're talking about decumulation and withdrawal sequencing. Start with those taxable accounts first because that's where you won't incur a penalty and you can shield against taxes up to a certain amount, almost 100K. Short-term interest and capital gain is ordinary income. So if you have short-term interest or you have short-term capital gain, that is considered ordinary income and taxed at your ordinary income rate. So just be careful of that. Then you go to your tax deferred, assuming that you need access to tax deferred, your 401k, you have access to a loan through your 401k. Hopefully you won't need it, but those loans are, there's a interest rate that you pay against those loans, but you're paying yourself. But that also means that you're taking a loan out from your 401k and that 50K, up to 50K is not earning any income, right? Be careful about taking loans. And then lastly, Roth, because you want to maximize that tax-free growth and you want to take that to the very, very last, right? The exceptions might be Roth conversion, low income years. You want to convert from taxable accounts to the Roth account just so that you can then take that and wait until the very end to make use of the Roth funds. And then second is if you pass and you want your heirs to receive that stepped up basis, yeah, of course, there's not much more to do except for to pass it on to your heirs. Okay, so nuances. Again, you want to fill the low brackets. By that, you want to fill your 0% taxes, even like up to 10% or so, 12% tax brackets, right? So that you have to pay low taxes. And that is that is married with the Roth conversion. So if you convert Roth, you can convert up to a certain amount and you won't have to pay, you just pay those low taxes and you can manage that. You also have to plan for RMDs, require minimum distributions. And if you're close to retirement, you know that you have RMDs on traditional IRAs and 401ks, but you don't have any RMDs, require minimum distributions with Roth IRAs. So that's the great thing about Roth. You are not required to actually take distributions of these RMDs. If you have it in those Roth accounts, you can keep it in the Roth accounts, continue to grow in perpetuity. Whereas 401ks, you're required to take those distributions at a certain date when you're past 70. And then keep a couple of years of cash flow for a buffer for downturns, right? Especially in this market, who knows what's going to happen? If you're furloughed, if you're fired, you want to have that cash flow so that you don't have to withdraw from your taxable accounts and then take that tax hit in the year of high taxes. If you keep that years of cash flow, you can have that buffer. Now, that being said, you could put it into a high yield savings account that may have a 1 to 2 to 3 month hold on the account and still be earning quite a bit. Traditional savings accounts earn about 4 to 5%. Do your investigation. We'll talk about high yield savings accounts or really private credit accounts that offer you a much higher return than that. And still, they don't have the 1 year hold, they have a much shorter hold period. So do your do investigation or reach out to us and we'll fill you in on what that might be. And of course, if there are any downturns, adjust your strategy accordingly. You might want to increase it, decrease it, depending on how the market is doing. Okay, and then contingency planning. So if you happen to retire before Medicare age, then you have to find some type of healthcare plan, right? There's ACA, so you have that pre-Medicare requirement. Just note that's the case. Everyone who is in fire, that's before retirement age, has to deal with that. Inflation, also make sure that you account for inflation about 3% every year. That's probably sufficient.
The 4% and 3% rules you mentioned earlier, do those account for inflation? And if so, like what assumptions do they make about inflation?
Yeah, they do. The idea behind the 4% rule is that it accounts for essentially your expenses. So the 4% is if your expenses is about 10,000 a year, and 10,000 a month rather, 120,000 a year, then 100 over 4 or 24 times that expense amount is how much you need. It also, and the one thing I did, so thank you very much for bringing it up. The one thing that the 4% rule states is that 4% is for the first year, 4% of your investment portfolio in the first year. And then every year thereafter, you account for the inflation up or down. So you have to increase it for inflation or decrease it for like deflation. So it's not a fixed 4% as much as it sounds like it's a 4% rule. 4% is just for the first year, and then you increase it or decrease it according to what the market, what the overall market is bearing. So if there's inflation, you have to increase the 4% by that dollar amount by a little bit.
So if there's, call it inflation's 2%, then in year two, does that mean you need 6%?
So it means 4%, that 24 times your first year. So it's 20, let's say 24 times your 120,000, right, is 3 million. And then the next year, if inflation goes up by 3%, let's say, or 2%, to make it easy, 2%, then that 120,000 goes up by 2%. So it's just the
Oh,
base amount goes up by 2%, not the 4%.
yeah. Okay. Okay.
Yeah. And hopefully, and the idea behind the 4% is that you would earn a higher amount than 4%, right? Your income producing assets would be earning at a higher amount than 4%. But worst case, over the 30-year life of your investment portfolio, if the market went up and down, it has to outperform 4% for you to have an investment basis that would sustain 30 years, 30-year retirement. Again, adjusted for inflation. So thank you very much for bringing that up. Okay, so black swan events, if there, God forbid, is another 2008 or 1920 events, the market crashes. And Bill Bengen, when he did his analysis, did look at 1920s all the way up to, I believe it's early 2020s. And so he did account for these black swan events where the market crashed in 2007, 2008, and then in the early 2000s, and then also late 90s and then the 20s, 1920s. So he did account for that. And then your family needs. If you have family needs and you have to withdraw, you have that 6 month or 1 year of cash that's available to you. Lifestyle creep. The simple notion here is you may be taking a lot of unplanned vacations or maybe planned vacations, and maybe you need to scale back. So that's what lifestyle creep is. If you are looking for, that the next car, sports car, it might be a lifestyle creep you may have to look at and factor into your financial planning. And then you might have to fall back to work. So that's not the end of the world. If you have to unretire and continue earning until you get back up to your fine number, so be it. Account for that as well. So in summary, like stress test your numbers, make sure that you account for inflation, downturns, any tax changes, right? We don't know tax changes, but if you have your tax rate, you know where you are. We can help with some mitigating some of those taxes, but try to account for as many of those factors as possible. Plan for this withdrawal order, right? Be tax efficient in how you sequence your withdrawals. Make sure you stay liquid and you have an emergency buffer. And who knows when those black swan events will come up. If you have that buffer, that cash buffer, you can account for those. And then, of course, reassess when you need to, whether it's annually or biannually or semi-annually. Do that. You can adjust as needed. It's not the end of the world. Just be comfortable in your financial retirement. So with that, I'm going to pass it back to Keshav and talk about any educational resources that we have, and then we'll answer any questions.
Yeah, thanks so much, John. So here are some educational resources. Again, we focus on helping people diversify outside of the stock market. So that's why our first ebook here on the left, the QR code's called Investing Outside the Stock Market. You can find this if you go to our website too, clivecap.com. And definitely check out our YouTube, Keshav Kolur Clive Capital. This episode's going to be up on there as well as a lot of all of our previous episodes and the ones going forward. And this podcast, Investing for Generational Wealth, is on all the major platforms too: Spotify, Amazon Music, Apple Music, iHeartRadio, Pandora, you name it. And so with that, here's our contact information as well and how you can reach out to us, call us, email us, schedule a call. And so that brings us to the end of today's episode. John, thank you for talking about how you've been planning for financial independence all these years, how it came in handy, how others can do the same as well. It's encouraging to hear that someone from tech has been able to retire early and exactly the path that they followed, especially using our private equity syndication strategies too. And so we'll have a follow-up to this episode. Most of the advice in this episode was geared around the stock market. And if you've been following us, we don't like the stock market. Your average index funds, ETFs, that average 10% a year over the last 15 years. We can do better than that. There's no tax benefits in there too. There's too much volatility. So on a future episode, we'll talk about the private equity, the syndication version of how you can get to FIRE and what that road looks like and how it's actually much quicker than just relying on the typical stock market route. For those of you listening at home, thank you for joining us today to learn about financial independence, how you can use some of these basic strategies, no matter where you are in your financial journey, to get started on your road to financial independence. And then again, in a future episode, we'll talk about, hey, if you're a high net worth earner, if you're a high earner, what are some additional strategies you can utilize to really pour gasoline on the fire, pun intended, and hit your goals much quicker. So that's it for today's episode. John, thank you for coming on today and speaking about financial independence.
Absolutely. Happy to do it. Want more people to join me in my FIRE journey.
And for those of you listening at home, feel free to reach out with any questions you have. Thank you for listening to today's episode of Investing for Generational Wealth. And until next time, keep investing and keep learning.